Today we're going to talk about the US election and the impact on US interest rates. Good morning and welcome to Morning Markets. With the US election a month away and the Federal Reserve having already cut interest rates once, the impact of the election on US interest rate cuts in the future is important. Firstly, what's currently priced for interest rate cuts over the next year or so? At the moment, future markets are pricing interest rate cuts from 5% currently to 3.5% by the end of next year. So that's quite an aggressive easing cycle for interest rates, but from historically quite high levels. And what's interesting about the current cycle is that the recent peak in interest rates was actually above previous peaks in interest rates. That's the first time this has happened for several decades. This cycle is unusual in many ways. We're going into an interest rate cutting cycle with very strong growth, still low unemployment at just 4.1%, and a government deficit, a fiscal deficit of 6.5%. So the impact of the election on that interest rate cutting cycle is critical. If we think about some of the outcomes from the US election, perhaps the most significant in terms of the impact on interest rates would be a Republican sweep. So Trump winning the presidential election and the Republicans winning both houses. The impact of that would probably be further tax cuts, large fiscal deficits, so from an already quite wide fiscal deficit of 6.5%, we'd see an expansion of that deficit. We'd see tariffs on imported goods, and overall the impact would likely be inflationary. So the implication for interest rates might be that those quite aggressive interest rate cuts that are priced into the market between now and the end of 2025 might not come to fruition. So that would have quite a big impact on the bond market. It will probably be positive for the equity market because of the impact of those corporate tax cuts, but the impact on the bond market might be negative. Any of the other outcomes, so a Democratic sweep would probably result in funded spending so that there would actually be some tax increases, so that might not be so good for the equity market, but it might be better for the bond market, or a mixed Republican and Democrat Congress would probably be fiscally neutral, but starting from, as I said earlier, quite a large fiscal deficit. So the potential for interest rate cuts that have been priced over the next year or so to be priced out, so some reversal of those interest rate cut expectations is there with the election looming over the next month. Thank you for listening.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.